What if I told you that, one of the most profitable, sophisticated financial and lifestyle brands in the world today isn't a bank?
Right, or a luxury fashion house for that matter.
Exactly. What if I told you it's actually a company that, basically just flies metal tubes through the sky?
It sounds like a punchline, honestly.
It really does.
Yeah.
But welcome to a highly targeted, investor-focused Talk Tickers edition of The Deep Dive,
Where we try to figure out what's actually going on.
Right. And today we are looking at a business that is completely rewriting the rules of what is historically the most brutal, capital-destroying industry on the planet.
100%. The airline industry.
Yeah. We are breaking down Delta Airlines' incredibly fresh Q2 2026 earnings call, which, by the way, just dropped yesterday, July 10th, 2026.
Fresh off the wire.
Exactly. So if you hold the stock ticker symbol DAAL, or if you're even just remotely interested in how modern mega corporations engineer their margins, you have to stick around because the sheer mechanics of this quarter are, they're just fascinating.
They really are.
Yeah.
And, the broader context here is really what makes this specific quarter so compelling.
Set the stage for us a bit.
Sure. So if you look at the last, say, 40 years of aviation history, airlines are notoriously difficult for investors.
Brutal.
Right. It is a sector plagued by just wild fuel volatility, cutthroat price wars, and these massive, unavoidable capital expenditures.
Didn't Warren Buffett have a joke about that?
Yeah, he famously joked that a true capitalist should have shot down the Wright brothers at Kitty Hawk just to save future investors the financial agony.
That's hilarious. And honestly, for a long time, totally accurate.
Exactly. But Delta's CEO, Ed Bastian, is making a very bold claim right now.
What's he saying?
He is stating that the industry is undergoing a permanent structural change.
Wow. Permanent.
And that Delta is no longer just a transportation company, but a premium retailer leading that change.
Which, that is a massive claim to make when you are still entirely dependent on the price of jet fuel and, the physical delivery of aircraft.
Oh, absolutely. The burden of proof is heavily on them.
Right. So in true Talk Tickers fashion, we are going to be incredibly data forward today. We're going to translate all that dense Wall Street jargon into plain English.
Because nobody wants to listen to a textbook.
No, definitely not. We are hunting for actionable, opinionated insights on what this actually means for you if you're holding the underlying equity. So let's just start with the sheer scale of the revenue.
Let's do it.
Because the numbers that hit the wire yesterday morning, they really made everyone do a double take. Delta reported $17.7 billion in top-line revenue for a single quarter.
Yeah, 17.7. And that figure represents a 14% increase year over year.
14%?
Yeah, we are talking about a $2 billion expansion over the exact same period last year.
That is just wild for a legacy airline.
It really is. To generate that kind of top-line growth in a relatively mature market is highly unusual.
But top-line vanity metrics only tell you that they're moving money around.
Exactly. It's revenue, not necessarily wealth.
All right. The true indicator of health is what falls to the bottom line. And the profitability here was incredibly robust. They delivered $1.4 billion in pre-tax profits.
Which is a very healthy margin.
Yeah, meaning they hit an earnings per share, an EPS of $1.56, beating the guidance they gave Wall Street at the very beginning of the quarter.
They cleared the bear.
They did. But, we promised to look past the superficial headline numbers. Any company can juice their EPS for a quarter or two with accounting.
Oh, totally. Buybacks, deferred maintenance, you name it.
Right. The metric that really caught my eye, the one that separates a wealth-generating business from a capital incinerator, is their return on invested capital, or ROIC.
This is the big one.
It is. They printed an 11% ROIC, which, for an airline, that number is almost defiant.
Defiant is the perfect word, because it fundamentally challenges the historical narrative of the entire sector.
Break that down for us. Why is ROIC so crucial here?
Well, for those tracking the balance sheet mechanics, ROIC is the ultimate litmus test of capital allocation. An airline is, by definition, a heavy asset business.
Yeah, it's for heavy.
Right. You are buying Boeing and Airbus jets that run upwards of $100 million apiece. You are financing the construction of massive terminal infrastructures.
Yeah, specialized maintenance hangars, baggage systems.
Exactly. The capital requirements are just endless, just to maintain the status quo.
You can't just bootstrap an airline from a coffee shop with a laptop.
Right. No. You need billions of dollars in physical assets just to get the first passenger off the ground. And all of that money has a cost attached to it.
Whether it's interest on debt or the returns demanded by equity investors. Right?
Precisely. Every corporation has a weighted average cost of capital. Let's assume, just given the current interest rate environment, a major airline's cost of capital hovers around, say, 8%.
Okay, 8%.
So if they borrow money at 8%, but the physical planes they buy only generate a 6% return on that invested capital.
They are actively destroying shareholder value every time a flight takes off.
Yes. They're essentially paying $1 to earn 80 cents. And historically, this is exactly what airlines did.
Wow. Just burning cash.
They chased market share over margins that flood the market with cheap seats and subsequently fail to earn their cost of capital.
I mean, it's the equivalent of taking out a massive small business loan at a 10% interest rate to buy inventory that only yields a 5% margin.
Exactly. The faster you grow, the faster you bleed out.
Which usually ends in Chapter 11 bankruptcy. And the airline industry has seen plenty of those.
Oh, littered with them. But that 11% ROIC, that signifies that Delta has broken that cycle.
Because they're beating the 8% cost.
Significantly beating their cost of capital. When they deploy $1 of investor money to acquire a new aircraft or, upgrade a Sky Club lounge or invest in new technology, they are generating a return that creates tangible structural wealth.
So they aren't just treading water to service their debt?
No, they are generating massive surplus.
And we see that surplus flowing directly into the cash flow statements, actually.
Let's talk about the cash flow.
Yeah, so through the first half of 2026, they generated $1.4 billion in free cash flow.
That is real cash, not an accounting metric.
Real cash in the bank. And that surplus gave management the confidence to announce a 15% increase in their dividend.
Which is huge.
Huge. For an income-focused investor, seeing a legacy airline raise a dividend by double digits is a massive signal of fundamental balance sheet confidence.
It really suggests management believes the cash generation is durable. This isn't just a post-pandemic anomaly or revenge travel.
Right. But this is where the narrative gets complicated and where I really need to challenge the underlying mechanics of this quarter.
Oh, where's the red flag?
I am looking at the operating expenses. $17.7 billion in revenue is phenomenal. But there is a massive barrel of oil sitting right in the middle of this earnings report.
The fuel bill.
Yeah. Delta's chief financial officer, Eric Snell, explicitly detailed that their total fuel expense for the quarter was $4.4 billion.
4.4.
That is up nearly $2 billion from the same period last year. They were paying an average of $3.93 a gallon.
Which is historically very high.
Right. So if a company's single largest variable cost skyrockets by $2 billion, the margins should theoretically collapse. How did they manage to beat their profit guidance while absorbing the highest fuel costs in the history of the company?
It's a great question. And honestly, the historical precedent would entirely agree with your skepticism. Oil price spikes are the traditional grim reaper for airline equities.
Exactly.
But the mechanism Delta used to survive this quarter is actually the clearest evidence of the structural change Ed Bastian keeps emphasizing.
Yeah, okay, what did they do?
They executed a highly sophisticated strategy that their chief commercial officer, Joe Esposito, referred to as fuel recapture.
Recapture, which implies they took that $2 billion hit and successfully transferred it directly to the passenger without the passenger deciding to just stay home.
That's exactly it. The mechanics of how they did it involved the booking curve and algorithmic yield management.
Walk us through that.
You have to visualize the timeline of airline ticket sales.
Yeah.
The massive spike in crude oil didn't happen overnight, right? It began gaining serious momentum early in the year.
Yeah, around February, March.
Right. And Esposito noted on the call that the revenue management team started executing this recapture strategy back in March. By the time April arrived, which is the start of the second quarter, Delta was already 70% booked for the upcoming summer travel periods.
Wow, 70%.
Yeah. And those bookings were locked in at higher yields.
So they utilized the forward-looking nature of their business. They saw the crude curves shifting in February and March, and their pricing algorithms basically immediately started dynamically raising the floor prices of the fare buckets for flights in June and July.
Exactly. The critical metric here is TRASM, total revenue per available seat mile.
Right, TRASM. Wall Street loves that one.
It is the core indicator of how effectively an airline is monetizing its physical capacity. The exit rate on their TRASM at the end of the second quarter was significantly higher than the entry rate at the beginning of the quarter.
Meaning they got better at making money as the quarter went on.
Yes, they successfully outran the inflation month by month. As the fuel costs crept up, the new revenue coming into the system was priced proportionately higher to reflect that new reality.
And the passengers just absorbed the cost. That is the real shocker to me. They raised fares to cover a $2 billion fuel spike, and demand didn't just evaporate.
People still wanted to fly. Which brings us to the operational reality of their unique fuel hedging strategy. Because it wasn't just ticket prices.
Right.
Unlike traditional financial hedges, which have honestly become prohibitively expensive for most airlines, Delta owns physical refining capacity. They own the Monroe Trainer refinery in Pennsylvania.
Right, which is just a wild asset for an airline to have on its balance sheet. I really don't think most retail investors realize Delta is literally also in the oil refining business.
It was a highly controversial acquisition when they bought it years ago. People thought they were crazy, but it serves a very specific strategic purpose.
How does it work?
So the refinery isn't there to bet on the raw price of crude oil. It exists to hedge against the crack spread.
The crack spread, let's translate that.
Yeah, the crack spread is basically the premium that refineries charge to take unrefined crude oil out of the ground and process it into usable jet fuel.
Okay.
When refining capacity gets tight, which happens often due to geopolitical shocks or even just refinery shutdowns for maintenance, that spread explodes. The premium goes through the roof.
Right.
The Monroe Trainer refinery produces refined products that Delta can either use themselves or trade on the market. That effectively offsets the massive premiums the rest of the airline industry has to pay for jet fuel.
Okay, but I noticed they had a major hiccup at that facility this quarter. Eric Snell mentioned a temporary outage at the refinery.
They did. The facility went offline a couple of weeks before the earnings call.
So it wasn't a perfect shield.
No, not this quarter. That outage hit their bottom line for about 5 cents per share in the second quarter.
Okay, 5 cents.
But they reported they are currently back up to about 75% throughput capacity. There will be a slight residual tail to that outage bleeding into the third quarter. They estimate maybe another 5 to 7 cent hit.
But overall.
But net of that temporary disruption, management expects the refinery to actually provide a 5-cent benefit overall in Q3.
Wow. And if you look at the forward curves for crack spreads, especially heading into the winter, I mean, having physical production capacity is just a massive structural advantage.
It's a huge moat.
But even with the refinery offsetting some of the refining premiums, the baseline cost of fuel was still objectively massive, which transitions us to what I think is the most important question of this entire deep dive.
Let's hear it.
The math says they successfully passed a $2 billion cost increase onto the consumer. But why didn't the consumer balk? 10 years ago, if a legacy carrier raised fares to cover a fuel spike, passengers would immediately abandon them for a low-cost carrier, like a Spirit or a Frontier.
Oh, in a heartbeat.
Right. So why didn't they this time?
That behavioral shift is the crux of this entire earnings call.
Yeah.
To understand how they achieved this, we have to analyze how Delta has intentionally decommoditized the concept of air travel.
Decommoditized, meaning it's no longer just a race for the cheapest seat.
Exactly. During the Q&A portion of the call, an analyst from Deutsche Bank, Mike Linenberg, pressed Ed Bastian on this exact dynamic. Linenberg pointed out that the traditional discount airlines, the ones that historically rely on capturing price-sensitive customers when legacy fares go up, they are currently struggling immensely.
They are getting crushed right now.
Yeah. And Bastian's response provided a just brutal post-mortem on the low-cost carrier business model.
What did he say?
He laid out how, a decade ago, the ultra-low-cost carriers were the darlings of Wall Street. They boasted the highest margins, the most aggressive growth rates. They basically weaponized low costs against the legacy carriers.
Because they had structural advantages back then.
Huge ones.
Yeah.
They had non-unionized cheap labor. They operated out of secondary airports with really low landing fees. They ran older, cheaper technology. And some of them had massive multi-year financial fuel hedges in place that allowed them to keep fares artificially low even when oil spiked.
So they were basically insulated.
Yes. But Bastian systematically detailed how every single one of those structural advantages has been eradicated today.
Every single one?
Every single one. Following the pandemic, labor costs reset massively across the entire aviation sector. Pilots, flight attendants, mechanics, They've all secured historic, expensive contracts.
You can't underpay pilots anymore.
Right. And secondary airports realize their leverage, so they raise their landing fees. Modernizing technology and cybersecurity, that is now a mandatory multi-billion-dollar expense. You can't skimp on it.
And the planes themselves.
The cost to acquire and finance new aircraft has surged due to high interest rates and manufacturing delays at Boeing and Airbus.
So the cheap airline model is basically dead. It fundamentally alters the unit economics of the industry. The baseline cost of operating a commercial flight has risen so dramatically that the discount model is mathematically broken.
It's totally broken.
You know, it reminds me of the dynamics we see in the restaurant industry.
How so?
Like when the wholesale price of beef and the minimum wage for hourly labor skyrocket simultaneously, the discount fast food chains suffered the absolute worst margin compression.
Right. Because their burgers are already so cheap.
Exactly. Their entire model relies on razor-thin margins and massive volume. They have zero financial buffer to absorb the inflation. If beef goes up, they have to raise prices, and suddenly a fast food meal is $15, and the customer feels ripped off.
Yep.
Meanwhile, a high-end premium steakhouse can just adjust the price of a prime ribeye by, 10 or 15 bucks. Their clientele is wealthy, less price sensitive, and they're paying for the ambiance and service. They barely blink at the price increase.
The math supports that analogy perfectly. When you look at the cost structure of the discount carriers right now, they have lost their buffer. Bastian actually estimated on the call that the low end of the market still needs to increase their baseline fares by at least another 5% right now, just to break even in the current fuel and labor environment.
Just to break even.
Yeah. And because the floor has been raised so high across the industry, Delta isn't forced to fight a race to the bottom price war in basic economy anymore.
So they have abandoned the fast food model entirely and leaned completely into the premium steakhouse strategy.
100%. And here is where this strategy evolves from just selling slightly nicer seats into a massive financial ecosystem. Delta is actively diversifying its revenue streams away from the physical constraints of an airplane.
Right, because you can only fit so many seats in a tube.
Exactly. And the most glaring example of this diversification is the Delta American Express partnership. The numbers Joe Esposito presented regarding their credit card portfolio are just staggering.
Let's dig into that, because the Amex partnership is basically the financial fortress protecting their margins at this point.
It really is. Card spend on the Delta American Express portfolio has grown by double digits for 7 consecutive quarters.
7 quarters of double-digit growth.
Yeah. And the underlying demographic data is perhaps the most surprising element of the whole call. The strength isn't just coming from, older, established corporate executives.
Which is who you'd expect.
Right. Delta is seeing massive gains in their premium reserve cardholders driven heavily by Gen Z consumers.
Let's pause on that, because Gen Z is not the demographic you traditionally associate with ultra-premium, high annual fee airline credit cards.
Not at all.
Some of these cards have, a $650 annual fee?
Yep. The reserve card is pricey, but it reveals a profound macroeconomic shift in consumer behavior. Younger generations are demonstrably prioritizing experiences, travel, and status over the accumulation of physical goods.
It's the experiences economy.
Right. They're willing to pay that high annual fee because they value the lounge access, the boarding priority, and the frictionless travel experience it provides. And because of this relentless momentum, Delta's management confirmed they expect total remuneration from American Express to hit $9 billion this year.
$9 billion. Let's contextualize that against their total revenue.
Right.
If they did $17.7 billion in total revenue this quarter, that means roughly $2.25 billion a quarter is coming straight from Amex.
Just from swiping credit card.
We are talking about well over 10% of their total quarterly revenue being generated by a credit card partnership. That is insane.
And the margin profile of that $9 billion is what makes it so critical for investors to understand.
Oh, because it's asset light.
Extremely. Delta is effectively minting its own shadow currency, Sky Miles, and selling them at a massive premium to American Express.
And then American Express uses those miles as a customer acquisition and retention tool for their own business.
Exactly. When Delta records that revenue, they aren't burning expensive jet fuel to generate it. They aren't paying pilot salaries or airport landing fees to generate it. It is an incredibly lucrative asset-light data and loyalty stream that fundamentally elevates the margin profile of the entire airline.
It basically operates as a high-margin financial services business embedded inside a transportation company.
Precisely.
That $9 billion buffer really protects them on the consumer leisure side. But, leisure spending is only half the battle.
Let's talk about corporate.
Right, because if the macroeconomic environment cools down, consumer credit card spend could slow. So the real test of Delta's armor is what is happening with corporate travel, which is historically the absolute lifeblood of airline profitability.
Totally. And the narrative during the pandemic was that corporate travel was permanently impaired. The assumption was that Zoom and digital conferencing had permanently destroyed the need for business trips.
Everyone thought we'd never fly for a meeting again.
Joe Esposito directly contradicted that narrative on the call. Corporate travel is booming. Delta reported double-digit growth in corporate sales across all sectors.
And the geographic concentration of that growth is very telling, I think. They highlighted their core coastal hubs, places like Los Angeles and Boston, where corporate sales rose between 20 and 30% compared to the prior year.
Which is massive growth.
Yeah. That tells me the tech, finance, and consulting sectors are back on the road aggressively.
They are. And Delta is evolving the physical layout of their aircraft to aggressively capture that returning corporate spend. They are completely rethinking the real estate inside the tube.
Taking out cheap seats.
Yes. Main cabin capacity, which is the standard traditional economy seating, is actually down 2 to 3%. They are actively shrinking the supply of cheap seats. Conversely, premium capacity across the fleet is up low single digits.
So they are replacing low-margin real estate with high-margin real estate.
Exactly.
But it goes deeper than just adding more big seats to the front of the plane, right? They're applying some highly sophisticated retail psychology to how they actually sell those premium seats.
It's all about cabin segmentation. The segmentation strategy is brilliant. They aren't just selling a binary choice between first class and coach anymore.
Right.
Within their premium cabins, specifically starting with Delta Comfort, they have rolled out 3 distinct tiers: Basic, Classic, and Extra. And they announced on this call that they are expanding that 3-tier segmentation across all of their premium cabins.
Walk me through the mechanics of that. Why take a premium product and attach a basic label to it? It sounds counterintuitive to the whole luxury brand they're trying to build.
It sounds weird, but it is entirely about unbundling the fare to capture maximum willingness to pay. A basic premium fare gets you the physical, nicer seat, but it might strip away your ability to change the ticket or cancel for a refund or even select your exact seat location in advance.
I see.
An analyst from JP Morgan, Jamie Baker, actually asked a very perceptive question about this on the call. He asked if corporate travel managers, the people who buy tickets from massive companies, would block their employees from buying these new basic premium fares in the same way they already block employees from buying basic economy fares.
Oh, because corporate travel demands flexibility. If a client meeting changes at the last minute, the employee needs to be able to change their flight without a massive penalty.
Precisely. And management confirmed they anticipate exactly that behavior. By intentionally making the lowest tier of the premium cabin restrictive, they effectively force corporate travelers to buy up to the higher yield Classic or Extra tiers just to get the flexibility they require.
That is so smart.
Right. Delta is driving improved revenue performance and higher yields from the exact same physical seat simply by altering the terms and conditions attached to the ticket.
They are literally monetizing flexibility. It is incredible. Now, beyond the credit cards and the complex ticket segmentation, I want to pivot to the hidden revenue gems buried in this earnings report.
There are a few good ones.
Yeah, there are massive side businesses operating under the Delta umbrella that retail investors often completely ignore. The first one is their tech ops division, specifically the MRO business.
Right, MRO. That stands for maintenance, repair, and overhaul. Delta operates one of the most sophisticated aviation maintenance infrastructures in the world. And the secret is, they don't just use it to fix their own fleet.
Right, they sell that expertise. Delta fixing other airlines' planes is projected to be a $1.2 billion business for them this year.
$1.2 billion.
And that represents a nearly 50% growth rate compared to last year. 50%.
The dynamics driving that growth are fascinating. Running a world-class maintenance hub requires massive fixed capital. You need sprawling hangar facilities, highly specialized diagnostic equipment, and thousands of highly trained FAA-certified mechanics.
It's not a cheap operation.
Not at all. Most smaller airlines or airlines looking to keep their fixed costs low simply cannot afford to build that infrastructure.
Yeah.
So they outsource it.
And Delta takes their existing fixed costs and turns them into a profit center.
Exactly. They're targeting double-digit margins for this MRO business, and they stated their goal is to expand those margins by a couple hundred basis points every single year.
And the demand for maintenance is skyrocketing right now, isn't it? Because of the engine durability issues plaguing the whole industry.
Yes, it's a huge problem right now.
If you follow aviation broadly, you know that the newest generation of highly efficient jet engines, particularly the geared turbofans, are spending far more time on the ground requiring complex overhauls than anyone originally modeled for. Delta has a record backlog of maintenance work precisely because the global fleet requires more servicing than ever before.
And it creates a tremendous moat for Delta. You cannot spin up an MRO operation overnight. It takes years of regulatory approval and capital investment. Delta expects to more than double their MRO revenue over the next several years, based entirely on their current contracted backlog.
Wow. The other hidden gem I want to touch on is their cargo operation.
Cargo was huge this quarter.
Cargo revenue grew by an astonishing 39% in the second quarter, and that was driven almost entirely by increased volume.
The cargo growth is a mix of structural investments and, honestly, geopolitical opportunism.
Explain the structural side first.
On the structural side, Delta has been heavily expanding their footprint in Asia, which is historically one of the largest and most lucrative cargo markets into the United States. They've upgraded their internal logistics capabilities, and the newer wide-body aircraft they're taking delivery of simply have more volumetric capacity in the belly for freight.
More room for boxes. But the geopolitical angle is what really drove the sudden volume spike.
Oh, totally. Due to the ongoing disruptions and security threats in the Red Sea and the broader Middle East, immense amounts of global freight have been rerouted from ocean shipping to air cargo.
Because it's too dangerous for the ships.
Exactly. And Delta had the capacity positioned in the right places to capture that diverted high-yield freight. And the beautiful thing is, because the aircraft is already scheduled and flying to transport the passengers in the cabin above, any cargo they pack into the belly is essentially pure margin enhancement.
The fuel is already being burned either way.
Exactly. Pure profit.
That's amazing. But, the culmination of all these diversified revenue streams, the Amex data, the MRO contracts, the cargo, the premium seating it all rests on one fragile foundation.
Operational reliability.
Operational reliability. If the planes don't fly on time or the bags get lost, the premium customer will abandon the brand. Regardless of how nice the Sky Club is or how great the steak tastes.
I'll leave in a second. And Chief Operating Officer Dan Janke spent significant time detailing their investments in the customer experience for this exact reason.
Because reliability is the entire justification for the premium price tag. If you charge steakhouse prices, you cannot serve cold food.
Great way to put it.
Janke highlighted their record baggage performance this quarter. They've made massive enhancements to their central baggage handling system in Atlanta, and they are powering it with proprietary patented AI technology.
Implementing AI into physical logistics like baggage routing is exactly how you prevent the catastrophic system-wide meltdowns we have seen paralyze other airlines in recent years.
Oh, the holiday meltdowns. We all remember those.
Right. But they are also deploying AI on the customer-facing side with Delta Concierge.
I read about this. It's a digital assistant integrated into the Delta app, right?
It is. It's currently available to over half of their app users, with a full system-wide rollout imminent. And the data they shared on its effectiveness is just remarkable. They are seeing a 25-point improvement in net promoter scores during irregular operations.
Wait, irregular operations. That means delays, cancellations, weather events, the moments when passengers are historically the most enraged.
Exactly. When a thunderstorm grounds flights in Atlanta, the AI assistant is proactively rebooking passengers, managing hotel accommodations, and providing real-time updates so smoothly that the customer's satisfaction score actually increases during a crisis.
That's almost hard to believe.
But it's working. They're using technology to neutralize the most painful friction points of air travel.
Add that to the fact that they are rolling out fast, free Wi-Fi across nearly the entire fleet. And they just announced they are moving to Amazon's Project Kuiper satellite technology, which they referred to as Amazon Leo in 2028, to unlock next-generation global connectivity.
High-speed internet everywhere.
Right. They are building a product that business travelers feel they literally cannot function without. You choose Delta because you know you can work on the plane, your bag will arrive, and if a storm hits, an AI will fix your itinerary before you even reach the customer service desk.
That holistic ecosystem is the moat.
All right, this transitions us perfectly into looking at the future. We know the premium strategy, the credit cards, and the operational tech are working wonders right now in Q2. But an investor buys a stock for future cash flows. Is management expecting these structural advantages to hold up against future turbulence? We have to look closely at their forward guidance.
Well, management affirmed their full-year guidance, which is a massive signal of confidence.
Remind us what that was.
Despite the fuel spikes and all the macroeconomic noise, they are still targeting $6.50 to $7.50 in earnings per share for the full year of 2026. And they expect to generate between $3 billion and $4 billion in free cash flow.
To put that in perspective for the listener, hitting that EPS target represents a 20% earnings growth year over year.
20%.
Achieving 20% earnings growth while navigating some of the highest fuel and labor costs in the industry's history is phenomenal execution. But I want to scrutinize how they are managing the physical growth of the airline to achieve that. Let's look at the supply side of the equation.
Okay, let's look at it. Their capacity discipline is rigorous. They stated that capacity will only be up 1% in the third quarter.
1%.
1%. And they are planning for highly restrained growth of just 2 to 3% in the fourth quarter.
And this is where I really have to push back on management's narrative.
Why is that?
Well, if demand is as incredibly strong as Joe Esposito claims, and if your premium cabins are selling out, and you have undeniable pricing power, why restrict growth to 1%?
You're saying why not fly more?
Yeah. Why not acquire more planes, grow capacity by 10%, and capture all that unfulfilled demand? Isn't artificially restricting growth just leaving money on the table?
It's the classic airline paradox, honestly. Historically, the moment airlines experienced high demand, they all simultaneously ordered dozens of planes and flooded the market with new capacity.
Which ruined it for everyone.
Exactly. When supply inevitably outstripped demand, pricing power collapsed and margins were destroyed. Restraint is how you protect margins.
Okay, but
your question assumes the restraint is entirely voluntary. Ed Bastian made it very clear on the call that this discipline is, in large part, being forced upon the industry by severe systemic constraints in the aerospace supply chain.
the Boeing and Airbus duopoly is broken.
Completely. Both Boeing and Airbus are heavily backed up with production delays, regulatory scrutiny, and massive supply chain bottlenecks. The physical delivery of new aircraft is years behind schedule.
You literally can't buy a plane right now, even if you want one.
Right. And furthermore, Bastian explicitly called out the engine manufacturers. He noted that the new engine technologies simply lack the time-on-wing durability of previous generations.
The geared turbofans we talked about earlier.
Yeah, exactly. Planes are spending significantly more time out of service, sitting in maintenance hangars waiting for engine overhauls.
Which ties perfectly back into why Delta's MRO business is booming, of course. But strategically, what you are saying is that even if a rival airline wanted to behave irrationally, flood the market with capacity, and trigger a price war,
Yes.
they literally cannot get their hands on the physical planes or the reliable engines to do it.
Yes. The global supply chain constraint acts as an impenetrable, industry-wide protective umbrella. It forces discipline on the entire sector, which inherently protects Delta's pricing power. They don't have to worry about a competitor dumping cheap seats on their most profitable routes because the competitor doesn't have the spare aircraft to fly them.
That is a fascinating dynamic. But Wall Street demands growth.
Yeah.
If you can't drastically increase the raw number of flights you operate because you can't get the planes, how do you grow revenue?
You grow through upgauging and highly targeted international expansion.
Let's unpack the mechanics of upgauging. It's a term analysts throw around all the time, but the underlying unit economics are brilliant.
Really brilliant.
Upgauging essentially means that instead of flying more individual planes, you fly larger planes on your existing routes.
Right. Think of it through the lens of commercial real estate. Imagine you own a luxury apartment building in a prime city center. You pay a fixed property tax, you pay a fixed salary to your building manager, and you have a set cost for the land.
Yeah.
If you want to increase your revenue, you can't necessarily buy the block next door, right? The real estate is constrained. But if you can magically add 5 extra floors of luxury penthouses on top of your existing building, your fixed costs remain almost entirely flat.
While all the new rental income from those penthouses drops straight to your bottom line.
Exactly. That is a perfect analogy for airline unit economics. Delta only has a finite number of landing slots at constrained airports like JFK in New York or Heathrow in London. You can't just invent a new 9:00 a.m. departure slot.
Right, the slots are fixed.
And you were paying a massive fixed fee for the gate, and you were paying the pilots a relatively fixed cost to fly the route. So Delta took a brief pause from upgauging over the last couple of years as they reset their fleet post-pandemic, but they are aggressively returning to it.
What planes are they bringing in?
Next year, they are taking delivery of the Boeing Hack X-10s. They will use these larger narrow-body aircraft to replace older, smaller planes like the Boeing 717s and 757s.
So the cost to operate the flight barely moves, but they suddenly have 30 or 40 additional seats to sell.
Yep. And many of them are configured as those highly profitable premium cabins.
And the margin expansion on international upgauging is even more dramatic. Right?
Oh, it's huge.
Ed Bastian highlighted their European network. When they take an older Boeing 767 off a transatlantic route and replace it with a modern Boeing 787, the financial profile of that single flight completely transforms.
Give us the numbers on that.
The 767 had roughly 30% premium seating. The 787 pushes that premium seating mix to over 50%.
Wow. And beyond the seat configuration, the 787 is vastly more fuel efficient per seat mile, and its larger cargo hold allows them to carry significantly more freight.
So you are simultaneously lowering the unit cost of production while dramatically increasing the high-yield revenue potential of the exact same route. It's a win-win.
And where are they pointing these newly upgauge international flights?
Well, they are strategically expanding where the premium demand is highest. In the Middle East, they specifically mention launching routes to Riyadh and reinstating service to Tel Aviv.
High business demand there.
Definitely. And they are heavily focused on Asia, adding capacity to markets like Hong Kong and Melbourne. A massive component of their Asian strategy relies on leveraging their joint venture with Korean Air.
It's just a great partnership. It allows Delta passengers to access 70 or 80 destinations across the continent seamlessly.
Right. And in South America, they're citing incredibly strong forward bookings stemming from their partnership with LATAM, developing robust connectivity through hubs like Lima, Santiago, Sao Paulo, and Bogota.
So when you combine the upgauging, the international joint ventures, the $9 billion Amex backstop, and the pricing power protected by supply constraints, what is the ultimate financial target here?
What's the finish line management is aiming for?
Well, CFO Eric Snell provided a very clear long-term framework. From a cost perspective, the goal is to achieve low single-digit unit cost growth.
Meaning they want to keep the cost of flying each individual seat mile as flat as humanly possible through scale and operational efficiency.
Exactly. But the real headline target came from Ed Bastian. His stated long-term vision is for Delta to achieve sustainable mid-teens pre-tax margins.
Mid-teens. I mean, achieving consistent mid-teens margins in the commercial airline industry was, historically, a mathematical impossibility for a legacy carrier.
It was considered completely absurd. But when you factor in all the structural changes we have discussed today, the permanent impairment of the ultra-low-cost model, the massive shift in consumer preference toward premium experiences, the high-margin revenue streams from MRO and loyalty programs, that mid-teens target is no longer a fantasy.
It's actually a highly plausible, sustainable reality.
It really is.
All right, this brings us to the most crucial segment of our deep dive. We have analyzed the historical data, we've decoded the management strategy, and we've examined their forward guidance. Now it is time to deliver on the core premise of talk tickers.
The verdict.
Right? What does this mountain of data actually mean for the retail investor listening right now? Let's synthesize the arguments and deliver our verdict. Let's start with the bull case.
Let's establish the bull case first, which is, frankly, incredibly compelling. The bull case rests on the premise that Delta's competitive moat is not just stable, it is widening every single day.
They are operating from a position of absolute financial strength, which is just rare in this sector.
Look at the balance sheet metrics Eric Snell highlighted.
Yeah.
It is objectively the strongest balance sheet in the company's history. They ended the second quarter with adjusted net debt of $13.6 billion, and they are actively targeting a gross leverage ratio of just 2 times by the end of the year.
The context around that leverage ratio is what makes it so powerful. You really have to contrast Delta's balance sheet against their peers right now.
Oh, it's night and day.
Because right now, several major competitors are bleeding cash. They are out in the market being forced to raise highly expensive capital at elevated interest rates just to survive the current labor contracts and fuel spikes.
Yeah, Delta is aggressively paying down their debt while their rivals are basically drowning in it.
That financial flexibility is a weapon.
It is. When the next inevitable macroeconomic crisis hits, or if a recession finally materializes, the company with the lowest debt burden and the highest free cash flow doesn't just weather the storm. They have the dry powder to play offense.
They can seize market share from distressed competitors.
Exactly. They can negotiate highly favorable terms with Boeing and Airbus for future aircraft deliveries because they actually have the cash to pay for them, and they can continue investing in the premium lounge experiences that their core customers demand.
Delta is entering an era where they have the financial mass to dictate terms to the market rather than constantly reacting to it.
That's a very strong bull thesis.
Okay, that is a very strong bull thesis. But to be responsible, we have to stress test that thesis. I want to look at the bear case. What are the systemic risks that an investor holding Delta equity needs to monitor closely? Because, look, no stock is invincible, especially not an airline.
The most significant vulnerability lies in the health of the macroeconomic environment. If we connect this specific earnings report to the broader global picture, it raises a critical question. What happens if the incredibly resilient U.S. consumer finally exhausts their savings and cracks under the pressure of sustained inflation?
That's the million-dollar question.
Delta has tied its entire future to the experiences economy. Currently, consumers are prioritizing a summer trip to Europe over buying a new television or remodeling their kitchen.
But premium leisure travel is the literal definition of discretionary spending. If a true deep recession hits, unemployment spikes, and wage growth stalls, paying $1,000 for a premium economy ticket to Rome is the very first thing a household cuts from their budget.
Exactly. And while Joe Esposito noted that corporate travel is rebounding beautifully right now, corporate travel budgets are notoriously elastic.
Very easy to cut.
Right. If corporate profits take a hit in a recessionary environment, chief financial officers across the Fortune 500 will immediately tighten their belts. They will slash travel budgets and mandate a return to digital Zoom meetings just to preserve cash. Delta is highly exposed to a contraction in corporate spending.
And beyond the consumer, we cannot ignore the physical realities of the business. No matter how much revenue you diversify into American Express credit cards and aircraft maintenance contracts, you are still fundamentally operating a fleet of massive jet engines.
You are buying and burning oil.
Exactly. You are entirely exposed to long-term fuel volatility. If geopolitical events trigger a massive sustained spike in crude oil, say, pushing it well past $100 a barrel, there is a mathematical limit to how much fare raising you can do before you actively destroy demand.
We already saw a glimpse of that vulnerability in this quarter's cargo data, actually.
Oh, with the Red Sea.
Yes. They benefited from rerouting freight around the Middle East this time, but that same geopolitical instability could easily disrupt their international passenger network or send global fuel markets into total chaos. Delta remains vulnerable to macro shocks, pandemics, wars, oil embargoes that are entirely outside of their management's control.
So, weighing the widening moat of the bull case against the macroeconomic vulnerabilities of the bear case, we need to land on a final, actionable talk ticker's verdict.
What's your take?
Based on everything we have unpacked today, my position is that Wall Street is mispricing the stock because they are still analyzing it through the lens of a traditional airline.
I agree.
Delta is no longer trading like a highly cyclical boom and bust transportation equity. Through their segmentation, their loyalty ecosystem, and their massive tech investments, it is operating like a premium consumer lifestyle and financial services brand.
The data supports that reclassification completely.
Yeah.
For an investor, your decision basically comes down to a fundamental bet on the psychology of the modern consumer.
Right.
If you believe that the U.S. consumer's prioritization of premium travel experiences is a permanent cultural shift, and if you believe that the obsession with credit card rewards, lounge access, and status is durable, then Delta is a completely different financial instrument than it was a decade ago.
They have structurally higher baseline margins. They possess a $9 billion cash-generating machine from American Express that insulates them from minor cyclical downturns.
And they have built a highly lucrative side hustle, overhauling other airlines' engines.
Exactly. In a high-interest rate environment where actual profitability and free cash flow generation matter more than speculative growth, Delta's 11% ROIC makes it a highly compelling hold for current investors. And honestly, a very strong consideration for anyone looking to initiate a new position in the consumer discretionary space.
They successfully navigated the hardest transition in business. They stopped competing on price, which is always a race to the bottom, and started competing entirely on value, reliability, and experience.
And it's working.
Historically, across almost every sector of the economy, the companies that successfully execute that leap capture the lion's share of the industry's total profit pool.
That is a brilliant way to frame it. Well, that brings us to the end of this Talk Tickers edition of the Deep Dive. We set out to look under the hood of Q2 2026, and we found a company that has fundamentally transformed from a blunt instrument of mass transit into a highly sophisticated, AI-powered premium retail machine. Thank you so much for joining us as we unpack the mechanics behind the numbers.
But before you close out the deep dive, I really want to leave you with one final unmentioned thread to pull on regarding the sheer scale of that Amex partnership.
Okay, lay it on us.
We analyzed how it generates $9 billion annually, which effectively makes Delta's SkyMiles program one of the largest and most lucrative credit card portfolios in the entire world, rivaling major standalone banks.
It's a mess.
Right. As airlines lean further and further into these high-margin, asset-light loyalty programs, and as they expand massive third-party repair businesses like MRO, are we rapidly approaching a future where the actual flying of the airplanes is no longer the core business?
Wait, are you suggesting the planes themselves are just a loss leader?
Think about the math. Is the multi-billion-dollar operation of flying a metal tube through the sky simply becoming a giant break-even marketing expense? An operational necessity required just to support a massive, highly profitable global financial and tech ecosystem.
That is a wild thought.
The next time you walk through an airport, scan your boarding pass on your app, swipe your premium credit card to enter the lounge, and order a drink. Look around and ask yourself, are you really a passenger on an airline, or are you just a highly monetized data point in a flying credit card commercial?